Good afternoon, ladies and gentlemen, and welcome to the Q4 FY2023-24 earnings call of Pondy Oxides and Chemicals Limited, hosted by AlphaStreet. This is Radhakrishnan Chonat from AlphaStreet, and it's a pleasure to host Pondy Oxides and Chemicals Limited for their quarterly earnings results conference call. From Pondy Oxides Management, we have Mr. K. Kumaravel, Director of Finance, Mr. Vijay Balakrishnan, CFO, and Mr. Piyush Dhawan, President, Commercial and Strategy. Ladies and gentlemen, as a reminder, today's call is being recorded. For professional investors, we are live streaming this audio along with the AI-generated transcript on our alphastreet.com platform. The replay audio of this call will be made available on alphastreet.com as well as on our YouTube channel. A final transcript will be made available shortly afterwards on AlphaStreet's platform as well. With that, may I now request Mr. Kumaravel to take you through the financial performance and highlights. Post that, we can start with the Q&A session. Over to you, Mr. Kumaravel.
Thank you, Mr. Radhakrishnan. Good afternoon, everyone. We wish you a warm welcome to POCL fourth quarter earnings call. We will briefly discuss the financial performance and highlights. As you are aware, we don't provide any specific guidance on our company's revenue or earnings, and any communication, discussion on this call, which reflect our outlook for the future and which could be construed as a forward-looking statement, must be reviewed in conjunction with the risk that the company may face. Before moving into the financial results and performance of the company, I would like to brief the current market scenario of our industry. The global automotive lead-acid battery market is valued at $18.31 billion in 2023 and is expected to reach $77.04 billion by 2031, and the market shows a steady CAGR of 5.5% from 2024 to 2031. The battery waste management rules and the EPR guidelines have augmented the growth of lead batteries in the domestic market. The concept of circular economy, ESG, technological improvements has become more relevant than it was before. We see exciting times ahead of us with such developments. I am pleased to inform that POCL has completed acquisition of 123 acres of industrial land parcel in Mundra, Gujarat state for rupees 41.40 crore. Though this acquisition, POCL will be strategically positioned to better service the western area and expand its export potential globally. Due to its proximity to the port and the region's continued industrialization and development, it will serve both domestic and foreign markets. POCL is expanding its lead production from 132,000 metric ton per annum to 204,000 metric ton per annum in two phases. The first phase will cater to expansion of 36,000 metric ton per annum in our Thiruvaikandigai unit in Tamil Nadu. We have already initiated civil work, application for licenses, and placed order for the machineries and machineries also in transit, and the project is expected to go live in Q3 24-25. This plant is specifically important for us and the industry, as it is one of the most modernized plant with cutting-edge automation, improved operational efficiency, and low on carbon footprint, as we are progressing towards an environment-friendly, sustainable manufacturing practices. Also, this plant will set the tone for our intent to voluntary ESG implementation. Further, POCL in Q4 2024 completed an issue and allotment of equity shares and warrants on preferential basis to the extent of rupees 132.50 crore. We have already received rupees 70.60 crore during this financial year, and the balance amount will be received within 18 months from the date of allotment, that is from 28th February 2024. The estimated capex for the first phase, as mentioned, is rupees 70 crore and will be funded through the proceeds of the preferential issue and the internal accruals. In the current financial year, POCL is looking at setting up of R&D facilities for creation of value-added products, both for the current portfolio and for the feasible products, which will add overall value to the top and bottom line of the company. With respect to the operational highlights, we wish to inform you that the capacity utilization of smelting has increased by 25% in FY24 from 34,000 metric ton to 42,500 metric ton. Sales mix between domestic and export market remained stable at 40% and 60% respectively. The percentage of value-added products in lead segment has been constant at 60%, with the new verticals contributing an extra 5% in value-added portfolio. Furthermore, in its first year of operation, POCL has achieved a top-line revenues of rupees 42 crore in aluminum division and rupees 21 crore in plastic division. POCL has commenced production and sale of plastic from this financial year and achieved the sales of 2,800 metric ton. In respect to our financial highlights, we are pleased to inform you that revenue from operation has increased to rupees 1,524 crore, up by 4% from the previous year on a standalone basis. EBITDA margin has remained relatively stable at 5% plus levels. Consolidated revenues from operation rose to rupees 1,541 crore, driven by a top-line increase in sale of other non-ferrous metals and plastics. Despite overall EBITDA and PAT margin showing a slight drop of 0.5% and 0.7% respectively, mainly on account of reduction in margin of other new verticals and increased finance costs, lead division margins have remained intact at 6.3% for the financial year 23-24. We have healthy balance sheet position with the consolidated net debt reduced by 52% to rupees 71 crore compared to rupees 147 crore last year, resulting in net debt equity at 0.2. The cash flow from operations stood at positive of rupees 64.31 crores for the financial year 24. The working capital days have improved to 53 days compared to 63 days in financial year 23, and current ratio has improved to 2.44 and ROCE stood strong at 17%. POCL has given a consistent dividend payout company since the inception. The board has recommended 50% dividend to the equity shareholders for the year 24, which is subjected to the approval of the shareholders. Our growth has been driven by increased capacities, value-added products, improved operating efficiencies, a healthy balance sheet, seasoned management, and enthusiastic support from the stakeholder, all of which is well balanced for POCL future growth. With the continuous support of our stakeholders, we have no doubt that POCL will accomplish its objectives and soar to the even greater heights. We appreciate you all participating in today's call. Over to you, Mr. Radhakrishnan.
Thank you, Mr. Kumaravel. Ladies and gentlemen, we'll now move into our question and answer session. Today we have participants joining via both the Zoom webinar platform as well as the telecalling platform. And for participants who have joined us and connected through the Zoom platform, can also post your questions directly using the chat functionality or raise your hand to ask a question directly to the Pondy Oxides management. As usual, we'll take the first few questions from the chat box as well as questions we have received via email and through our platform. And then we'll open it up for participants to ask questions directly. Ladies and gentlemen, once again, please use the raise hand functionality if you want to ask a question directly to the POCL management. Let me start with the questions that we have received via chat and email first. The first question is, could you provide an update on the progress of the MOU with the Tamil Nadu guidance?
Hi, RC. Piyush this side. I'll take this one. So I'll just give a background first and then give you an update. So the background is that we've signed an MOU with the Tamil Nadu guidance for establishing state-of-the-art cutting-edge recycling and manufacturing plants for non-ferrous metals, lithium-ion battery recycling, paper, plastics, rubber, and additionally also R&D facilities for creation of value-added products, both for the current portfolio and for other feasible products, which will add overall value to the top and the bottom line of the company. Now, coming to the progress, we've already initiated the work at the Thervoy Kandigai plant in Tamil Nadu from civil work and primary machines for the expansion of the lead project, where we are looking at expanding to additionally of 72,000 metric tons per annum in 2 phases of 36,000 metric tons each. Now, the investment program of INR 300 to 500 crores will span over 5 years, and accordingly, the preferential allotment was completed for INR 132.5 crores to fund the initial capex of 70 crores. We'll be adding other non-ferrous verticals after completion of the first 2 phases in Tamil Nadu, and consequently, we'll be establishing R&D facilities for product development for future expansion to create new verticals.
Thank you, Piyush. There's a follow-up question to this. Additionally, can you also tell how this agreement influenced the company's financials?
Hi, Asi. This is Vijay. So on the financial part, as you know, we have a strong balance sheet position as on date. So to fund our capex, the fundraising strategy will have an equitable mix of, debt and to reduce our equitable mix of debt and equity to reduce our overall weighted average cost of capital. So consequently, we are creating new verticals which are automated, low on carbon footprint, and operationally efficient. These investments over a period of time will increase our margins and also at the same time will increase the top and bottom line, which will result us in robust financials, over the long term.
Thank you, Vijay. The next question is, can you tell how has the company adapted its strategy to mitigate any potential impact on its operations?
Kumar will take this question. We have a diversified portfolio of lead, copper, plastics, aluminum, etc. And we are working towards creating a forward-looking portfolio for the company by adding potential verticals like lithium-ion, value-added products in the current portfolio with EPR. To mitigate the impacts on operation, we continue to concentrate on building a strong procurement base in both the domestic and international markets, targeting Tier 1 customers for long-term association, better capacity utilization in our current portfolio, increased capacities in smelting operation, long-term contracts with both the customers and suppliers, better operational efficiencies and the creation of value-added products with better yield and reducing logistics cost based on the hub and spoke model globally. Also, ESG goals are being worked upon, which will become a selling position and give us a competitive edge in the market.
Thank you, Mr. Kumaravel. We have one more question from the chat window. What are your views on the near-term global market conditions and their impact on Pondy's production costs and business operations?
So I'll take this one, RC. The global economic scenario remains volatile amidst tensions across different parts of the globe, as we are already aware of. Now, the fact is the corporates should be resilient to the global events to adapt and accordingly change these strategies so that they sustain in their respective businesses. Fortunately for us, in our 3-decade, the experience, POCL has seen such business cycles time and again and has consistently delivered results by overcoming such cycles. Majority of our sales are concentrated in the Asia Pacific region. And in case the freight costs for shipments from Europe and fuel costs increases due to any disruptions or so, the same will eventually be passed on to the customers. Also, the fact is that a couple of more additional things is that we have a large customer base and a supplier base in diverse geographies. Also, we have a very diverse portfolio when it comes to the non-ferrous and the plastic segment. Additionally, we are expanding our bases in the domestic footprint with respect to the EPR guidelines which are set forward by the government. And also the fact that we're using substitute fuels in case there are global scenarios of pricing differences. So that's our view on the near-term global market conditions. RC.
Thank you, Piyush. Appreciate that. Now, ladies and gentlemen, I'm going to open it up for the participants who have joined us via Zoom to ask any questions directly. Please use the raise hand functionality to let us know of your interest. I'll call out your name and unmute the participant. Just a small request, please announce your name and company affiliation before you ask your questions. Operators, please allow whoever has raised their hand to ask a question. And the first question we can take from Mr. Rajesh Mangal Agarwal. Rajesh, please unmute yourself.
Yeah, good afternoon. Thanks for the opportunity. I want please brief something about this acquisition of land at Mundra Airport, Mundra, Gujarat. You have already acquired this 123 acres of land. So, what is the future guidance? What you are going to do here?
So I'll take this one. Hi, Rajesh. Thank you for your question. So Mundra, as you are aware, I mean, first I'll give you a background. This is an industrial land, and this is a very large parcel as well. It's about 123 acres, and we have acquired due to strategic reasons. The first and foremost reason would be that it is just 16 kilometers away from the port. Additionally, we also see a lot of economies of scale in terms of costs when it comes to importing raw materials to Mundra and also exporting likewise. It also gives us a great footprint in the western region. If you see the history of POCL, we have been concentrated in the southern region only. But with our acquisition in Mundra, it gives us a sort of a pan-India presence, and we have a footprint in the west also now. Coming to the execution part of it, we are right now focusing on developing the Thervoy Kandigai land in Tamil Nadu, which was acquired last year. There we are expanding our lead operations to 72,000 metric tons per annum, focusing on the export markets. Mundra will eventually fall in place in terms of a strategic execution of a project dedicated for our portfolio in hand, and or maybe we can add a diversity in the portfolio in the coming months. So that part, the project team is kind of exploring and also doing a lot of feasibility analysis with respect to the project evolution. So we'll get back to you on that with further details when the time is right.
Yeah, thanks for the answer. And the second question is that you have already told this 36,000 metric ton capex will be done by Q3 24. And what about the next 36,000?
So once the Q3 number, so this Q3 capacity is 3,000 metric tons per month, which translates to 36,000 metric tons per annum. So we are looking at the phase 2 to start once this stabilizes, the target being maybe 6 to 8 months from the stabilization period, which is by the end of Q3 24-25, yeah.
Thanks for the same. And what is the future guideline for considering this? What is the future guidelines for top line growth in FY25 and 26?
So what we are targeting, I mean, again, for FY25, I mean, you're aware that we've ended this year at 1,542 crores, right?
Yeah.
1,542 crores. So we are looking at a number, say, between 1,800 to 2,000 crores next year. And eventually we would like to have a CAGR of somewhere between 20 to 25% year on year till we achieve our targets. And that is why if you see all the acquisitions, the land bank acquisitions, or the company acquisitions have been falling in place, and we've been executing projects time and again.
Yeah, thanks for the same. And considering this EBITDA and PAT margin is reducing year by year. So what is your future guidelines?
Okay, so this is interesting. So what happens is, Rajesh, when we start a project, so if whether it is an aluminium or plastics. Now coming to lead first. Lead, we have time and again delivered sustainable margins year on year. So that goes without saying. And we've kind of also improved basis points and are generating operational efficiencies year on year. So that is as far as lead is concerned. Now, when you enter a new vertical, whether it is a plastics or an aluminium or a copper, So there is generally a learning curve involved, and then that forms part of an investment in strategy, in terms of customer empanelments, in terms of finding the right raw material mix, in terms of finding the right finished good product portfolio mix. So I'll give you an example. In plastics, the general grade what we manufacture would be a C080, which is again a grade of which is benchmarked against the Reliance pricing and so many others. But then our idea of finding the right product mix would be to have a filled grade or a grade of an ABS or a nylon. So that we are evolving time and again, and we have seen progress. We have seen a certain amount of positive development in all the verticals, in all the new verticals that we have created since the last year. So we have to accept that this is a transition period, and the profitability will evolve over a period of time as far as the new verticals are concerned. But lead remains our hero product portfolio, and we are again concentrating to expanding there for 72,000 metric tons per annum from next year onwards.
To supplement further to Piyush's explanation, EBITDA on lead product is totally intact. It is above 6% only. You know, very well aware of that interest rates has gone up during this financial year of 23-24. So because of that, interest liability has gone up. Due to that reason only, net profit has come down, plus other overhead expenses because of the new project expansion as mentioned by Piyush. Otherwise, everything going well. If top line is going up, parallelly the same level of EBITDA margin will continue in the next financial year.
Yeah. Thanks for the same. And right, sir, I think we do not have upload any investor presentation, have we?
So you're right, Rajesh. So the idea is that we are working on a concrete presentation for the entire stakeholder and shareholder community. We have a vision in place where we want to achieve a certain target, and I mean, this would be a right platform also to mention that we have established a lot of verticals which will evolve over the next months, and we'll be adding a couple of other verticals as time comes. So we will be releasing our investor presentation, which will kind of enlighten everyone, the entire community, to how POCL has progressed and what POCL plans in the near future.
Yeah. It will be very helpful, sir. And last thing, sir, during your inaugural speech, I think you have told that if any freight etc. Freight cost is increased, you are very well pass on to that customer. Is it? Am I correct?
Yeah, correct.
Okay. See, I have listened too many con call, and where they people told that this is really a very problematic area in this to pass over this additional freight cost. So what I request you and suggest you, so if it is very good that if you are able to pass on the any additional cost, that it is very good. Otherwise, we may use any that what called.
This is passing on exclusively for metals, not for other overheads or fuels and other things. Main variation is metal, and metal prices is huge variation in this industry. That is passed on to customer. For other overhead increase, we have to absorb.
Okay. Thank you, sir. All the best for the future endeavor.
Thank you, sir.
Thank you, Mr. Rajesh.
Thank you, Mr. Rajesh, for your questions. The next question we'll take from the line of Ms. Divya Brijwani. Divya, please unmute yourself and go ahead and ask your question. Dia Brijwani. I'm sorry. Dia Brijwani, please go ahead. I'm not sure we can hear you. Can you please speak up? Dia Brijwani? All right, looks like we have some technical issues. We'll move to the next person, Mr. Giriraj Daga. Mr. Giriraj Daga, please unmute yourself and you can go ahead and ask your question.
Yeah, hello. Am I audible?
Yes, go ahead, Giriraj.
Yeah. So actually I'm new to the company. So I'll have some of the basic questions first. So first, why this quarter performance looks weak compared to last quarter on quarter as well as year on year? What went wrong there?
So actually, some of the orders of the customers, due to year-end inventory level, they want to push to the April. Whatever orders we received for March, due to the inventory holding problem, they wanted to dispatch during the month of April. Because of that, last quarter of March, sales is little down. And profitability, once it is, sales is down by 100 crore, actually equivalent profitability also will be down. Nothing else. Otherwise, if you see in the terms of profitability margin, EBITDA margin is intact throughout the year. In fact, in the same quarter, also the similar margin we earned in the previous year. If you see April and May, this again, whatever turnover we lost in the previous quarter is going up in the current financial year.
And when you say customer pushed, it means basically the OEMs like the automobile, Amara kind.
Yeah, sometimes, sir, sometimes.
And what percentage of, so first of all, what was the lead revenues? You mentioned about 42 crore of aluminum, 21 crore of plastics. Rest I'm assuming is all lead, right?
Yeah, all our other things are lead.
What was the lead volume, first of all, this year, full year FY24? And the second question is, what is the, let's say, proportionate of sales we are making to the OEM clients and what percentage we are selling to the spot market?
Okay, I am Vijay. I will take this question. So lead value, in fact, there is a volume-wise, there is a increase of about 5 to 6% in terms of lead volume.
Total volume.
Total volume is about 71,500 metric tons this year when compared to 70,300 metric tons last year. So and in terms of the spot market, generally we book most of the orders are being booked in the OEM market, where it is about 95% of the orders are long term. And balance, 3 or 5% of the orders we book on spot basis.
Okay. And like that's it, you have already done 32 capacity, right? 32,000. And when I look at the number 70,000, it's roughly about like 55%. What is the optimum utilization we can do? Like, can we do only maximum 75-65%, or can we push towards the 85-90% also?
So hi Giriraj, this is Piyush. So what you just mentioned about the finished volumes, which is 132,000 metric tons per annum, that would be a finished goods capacity, and versus what we're utilizing roughly about 72,000 as of now. It's good to have a little spare capacity, but yes, as of the moment we are underutilizing. Now to substantiate further, there are three verticals in lead recycling. So one would be your battery breaking, then smelting, and then refining. So what we have done, and we are concentrating on the expansion, is to increase our smelting capacities. Right now we have smelting capacities of roughly about 80,000 metric tons per annum. And that we are doubling basically in 2 phases to 160,000 metric tons per annum. Now this entirely depends upon the entire raw material portfolio you cater to. So if you buy batteries, then it kind of passes through 3 different verticals, and it adds on to your profitability. And then likewise, for each vertical, it has that behavior. Now, coming to the point where you asked about the capacities, once the expansion is done on smelting part, we have our focus on procuring batteries where we will see the transition on additional value addition in terms of profitability. As of now, yes, 70,000 is the finished goods target that we are achieving, which we plan to increase it to roughly about approximately 90,000 levels by the end of next financial year.
Okay. Just to understand the business model, like can this 204,000 and what you mentioned in the press release, total capacity from 132 to 204, can we sell, let's say, 170 out of that?
No, I didn't get your question. Could you please?
Is it physically possible? I'm not looking at a particular year, but is it physically possible that the 204,000 ton of capacity, which we are going to expand phase 1 and phase 2, 36 each, can we sell 160, 170 optimally in a year from that capacity?
In an ideal scenario, the answer is in the positive. Yes, we can. So we have finished goods capacity, the refining capacities are there, the smelting capacity by the end of the 2 expansions would be very ideal. And if we find the right raw material portfolio mix, we would definitely be in a position to cater to the numbers what you just pointed out.
Okay. Second question, somebody also mentioned about the Mundra land purchase. We are at the same time also having a large MOU with the Tamil Nadu government also.
Yeah.
So if I have to look at that priority wise, we are already doing expansion at our existing location, like from 132 to 204. Then we have Mundra, then we have Tamil Nadu. So will the Mundra project and Tamil Nadu run simultaneously, or we'll have to prioritize one of them to keep our leverage in check?
So you're right. Of course, the MOU is a non-binding agreement though, but the fact of the matter is our priorities are set on the Tamil Nadu Tharvoi Kandigai land, which we acquired last year in January 23 through the NCLT, and we are right now increasing our capacities there. We will be eventually looking at other non-ferrous options as well to kind of have a footprint in the same premises. When it comes to Mundra, it will overlap certainly at a certain point of time when we find the right product portfolio mix of value addition to be executed at the right stage. So that will overlap sometime, but as you said, our priorities right now is to expand the lead capacities to 72,000 metric tons per annum, which will result in an overall capacity of 204,000 tons per annum.
No, that understood. Just a follow-up on this. Like, can we see Mundra happening in, like, at least the project starting in FY25 itself, Mundra?
But still, board has not taken any decision on that. It is still discussion is going on. I cannot give immediate answer for this question. We come back to you at the appropriate time.
Okay. Mike, so some of the question on the business. When you say lead battery pricing, scrap battery pricing, okay, is it related to the lead prices, right? Is my understanding correct?
Yes, yes.
So generally, let's say if a lead prices are 2,200 in the international market, minus a spread of certain, let's say 10-12%, okay, that's where the battery scrap prices will be.
Yeah. Related to the price.
Okay, that's the right thought process, right? So gross margins are about like what, 12-13% in the lead segment?
Yeah, 11 to 12% is gross margin.
And how is this in aluminium and plastic?
So aluminium margins, so I'll just give you a perspective. First of all, like you said, lead is linked to the LME. That is correct. As a percentage of LME, we buy the respective raw materials, and the selling also happens as a percentage of the LME plus the premium. So that addresses your lead question. Now I'll walk you through the other as well. When it comes to aluminium, it works on a fixed pricing model of the OEMs present in India. The aluminium industry primarily caters to the automobile segment in India. Geographically, we are very well suited to where we are right now, which is in Sriperumbudur. So from an automobile perspective, we are very close to, say, a Renault, Nissan, a Hyundai, a TVS, and so many other OEMs. Now, when it comes to the margins, typically the margins would be around 7 to 8% for aluminium. However, if you see the entire trend in the industry for the last 1 year, aluminium sentiments were very low until things have started kind of coming back on the pipeline again. But aluminium, typically the margins should be between 6 to 8%. When it comes to plastics, to go back again to aluminium and plastics together, we have to find the right product portfolio mix. We've evolved in terms of manufacturing the die-cast alloys, in terms of manufacturing plastics granules at different variety, whether it's a polypropylene or whether it is an ABS or whether it is a nylon 6. But then again, finding the right product portfolio is what we are evolving since the last 1 year, and we are on our way to kind of having a concrete view of this is the portfolio what we will move ahead with.
No, understood. Just a follow-up here. What can be the, let's say, based on current capacities, what can be the peak revenue in each of the segment, aluminum and plastic?
So peak revenue for plastics would be close to 50 crores if what we would have targeted for this year. And for aluminium, So aluminium right now, what we are doing is the current portfolio mix is a very, I would say, is not the right profitable mix to attract this year. So what we are right now doing is that we are revisiting the product portfolio and finding out the right alloys which we would like to manufacture. And if everything goes right, we should be in a position to deliver about 250 crore turnover from aluminium if we find the right product mix.
250, and you are mentioning over time, right?
Over the next 1 year, subject to finding the right product mix, of course.
Okay.
But right now we are looking at opportunities of finding the right product mix for aluminium, because the die-cast series right now doesn't make practical commercial sense to us. So
as he mentioned, it is not, there is no hedging mechanism available right now for aluminium. Because of that, we are very slow phase we are going. But plastic is came online, that will give top line growth of maybe around 50 crore for the current financial year from plastics.
Okay. Last thing from my side, sir. In terms of raw material sourcing, like how, is there the long-term contract with the supplier, or we buy from the spot market? What is the system there, and that from the raw material supply?
So what Vijay mentioned earlier, if you look at the customers, right now we have 90% fixed contracts and 10%, 5 to 10% spot. Similarly, in the position what we are, we have a similar mechanism with the suppliers as well. So we have long-term supply contracts which date back to more than 5 to 10 years of our supplier relationships. So there as well we have long-term contracts, fixed volumes, and then as the market performs and behaves, we do spot contracts as well. And that the same mechanism is there in the domestic market also. This is as far as lead is concerned, and a similar approach we do for aluminium as well. When it comes to plastics right now, what we're doing is we're concentrating more on the internal batteries which are resulting in plastics. Typically 7% of a battery translates to a plastics, and out of which a PPCP or a ABS would generate a product portfolio. And then we also buy from the local market. Now, having EPR come into the picture under both battery waste management rules and plastic waste management rules, it kind of gives us a good leverage and footprint in the domestic market also. So as far as the procurement is concerned, we are very well placed in both the international and the domestic markets.
So in your press release, you mentioned the procurement mix of lead and plastic through imports is approximately 85% and 63%. Yeah. So our raw material of lead is 85% imported, right?
Yeah.
Yes.
Okay. So we still have decent domestic supplies of lead. So we are not able to get a hand on the domestic supply, or is this imports are more economical currently?
So what happens is, again, the right raw material portfolio has to fall in place. So we are expanding our footprint on the domestic segment as well. As you're very well aware, with the augmentation of the battery waste management rules and the EPR guidelines which have come into place, it gives us a lot of exposure to have the organized players, for organized players like us to get access to a lot of batteries, which kind of was routing out to the unorganized sector. So that way, I think by the end of the next financial year and moving ahead, we would probably have a better hold on the domestic segment also. And as far as imports is concerned, it's a matter of choice, and again, it's a matter of pricing. So wherever we find a level playing field, we will capitalize on that, and we continue to import.
More than that, hedging mechanism is not available for domestic supplies. It is available for the imports. It is not available in the domestic. So we have to do it very carefully.
And my question was actually the imports, we have long-term supplies also, like domestic.
Yes. Yeah, we have long-term supplies.
Okay. Thanks a lot and all the best.
Thank you.
Thank you, Mr. Giriraj. Ladies and gentlemen, I request you to limit yourself to maximum 5 questions and come back in queue. The next question we can have from the line of Mr. Pradeep Rawat. Pradeep, please unmute and go ahead.
Yeah. Good evening to everyone, and thank you for the opportunity. So I have some basic questions. So what is the revenue contribution from segments other than lead?
Okay, Vijay, I'll take this question. So in terms of aluminum, we had about 42 crores in turnover. And in terms of plastics, we had about 21 crores in turnover on a standalone basis.
Yeah, okay. And my next question is, why we had such low smelting capacity as compared to overall capacity earlier? Can we produce lead without smelting capacity?
So hi Pradeep, thank you for the question. So the answer is yes. Without the smelting capacities, you can produce pure lead and lead alloys. The raw material for that would be a typical lead scrap, which so what happens is, like I said before, the pricing, the procurement, and the right customer price also has to fall in place for that to happen. So we work on a lot of permutation and combination when it comes to finding the right portfolio mix of raw materials to cater to the 70,000 tons per annum what we have produced. Now, when we start expanding, so say 90,000 tons per annum for next year, we'll again have to concentrate on a mix of both smelting and refining to cater to the finished goods capacity.
Okay, so you said typical lead scrap. So what do you mean by that?
So that is called radio scrap in from history point of view. So you can use radio scrap to refine and manufacture lead or lead alloy. But then it would be really expensive. So that's why we go through the entire process of battery breaking, smelting, and refining.
This is a backward integration. Processing through the smelting is another backward integration where value addition is more.
Yeah.
Yeah, okay, understood. So we are increasing smelting capacity to 160,000 ton per annum.
That would be correct.
Yeah.
In 2 phases.
Yeah, so we can produce 160,000 ton per annum with like backward integration, right?
Yeah, correct.
Okay, and the rest would be like not so cost effective.
Yeah, it's not cost effective. We can manufacture. The balance anyhow, that quantity is to be met through the other scrap only.
Okay, so going forward 3-4 years down the line, so can we expect the capacity utilization to be somewhere near 80-90%?
I think 80% would be the right optimum mix because we need to have spare capacities as well. So 80%. But then again, in the next 3 to 5 years, we would also look at increasing further if there is an opportunity. So yeah, 80% would be an ideal mix.
Okay. So my next question is regarding the Tamil Nadu MOU. So what kind of investment are we going to commit to that project?
300 to 500 crore already we committed over the period of 5 years.
Yeah, and what could be the revenue potential from that capex?
So for the current project, we're looking at roughly about 1,500 crores, 1,200 to 1,500 crores from both the phases.
1,200 to
1,500 crores additionally for both the phases.
For the investment of 100 crore, we are going to do for the first phase, and balance 400 crore investment will give additional revenue that yet to be decided.
Yeah, and what would be the capacity for this capex?
So like I said, we are expanding another 72,000. So just look at the current product portfolio mix. I mean, the current revenues. So if we deliver another 70,000 tons of lead, then you have additional 1,200 to 1,400 crores in revenue, right?
Wait a minute, I just have a confusion. So we are expanding 72,000 ton per annum capacity in 2 phases, 36 plus 36, and that is that is Tamil Nadu MOU, right?
Yes.
Yeah. That is also one part of Tamil Nadu MOU.
Okay, so first phase would be for 70 crore and the second phase would be?
Another 50 crore.
Yeah, so what like the rest of the investment would be on what thing?
Other non-ferrous metal that we take it after completion of the lead portfolio.
Okay, so those capacities would be different from this, like
yeah, that is different.
Those would be the add-on on 72,000 ton per annum.
Yeah. That is different additional capacity.
So can you quantify that?
That cannot be quantified now. That
Okay.
it to be decided.
Yeah. Okay, thank you. That's all from my side.
Thank you.
Thank you, Mr. Pradeep. Next, we'll take the question from Mr. Aniket Gada. Aniket, please unmute yourself and go ahead and ask your question.
Hello. Hi. I just wanted to ask about the orders that have been pushed in April. In the balance sheet, the inventories have gone down from 150 odd crores to around 123 odd crores. So I just wanted to ask, like, why is that? In one scenario, we have inventory pile up because the suppliers have not, the customers have not taken up the products, and on the other side, we have a decrease in inventory.
No, but when there is orders is postponed to April, naturally our raw material procurement also be postponed to. Why should we keep more inventory and incur interest on that?
Okay. So going forward for the year, the inventory would be around this much only, 120 odd crores or something.
We want to reduce the inventory carrying cost, so we want to keep optimum inventory level at this.
Also, on the second part, if the 100 crore odd orders have been pushed in April, should we consider as right now, like 2 months have passed for quarter one, should we consider an improvement in the revenue for this quarter one?
Yeah, surely. Revenue is going up.
As compared to Q1 of FY24?
Yes.
Okay. On the other part, the aluminium, in the last phone call, the management has said like the aluminium run rate of revenue was 40 crores for 9 months, but currently for 12 months it's like 42 crores. So just 2 crores of revenue has been booked for this 3 months. So what is the scenario like? How low the revenue has fallen?
Hi, Aniket. So again, I'll just give you a background. The last 1 year in aluminium industry was almost a bloodbath. So it is basically the guys who have survived are all old players. Fortunately for us, it was a pilot plant, and we were getting empaneled with customers, and we were increasing our order strength and all of that. But then again, right now, what we are doing is revisiting the product portfolio mix. I will clarify the fact that we have been manufacturing the die-cast alloys which cater to the automobile industries. And what we're doing right now is we're reviewing the product portfolio and finding the right finished good for the right supplier customer, so that we get a value addition out of it, rather than, follow the bandwagon and, be part of negative numbers or, a volatility in the market. So we want to kind of get separated from the current product portfolio mix into a newer value addition one.
So how long this will happen, like low capacity utilization for aluminium?
Maybe till for the first 2 quarters, yes.
Okay. And in the plastics, last phone call you said like we are targeting to acquire more OEMs. But how many new OEMs have you acquired for plastics division this quarter?
So right now we have about I think 10 to 11 customers who we are supplying to. We are doing roughly about 400 to 500, between 440 to 500 tons a month to be precise. And we are right on the target of achieving the numbers of the standard capacities for this year from the same unit.
Okay, so but you are targeting like almost 120% increase in plastics revenue. So is it possible for this year, considering the number of clients we have and maybe?
No, last year figures is not comparable. Being the first year of operation, capacity utilization is low. So this year in plastic division, we are trying to achieve the capacity of 80%.
Yes.
Okay, the capacity for plastics is around 9,000 metric tons.
Yes. And we will be roughly targeting about 6,000 tons, which is about 400 to 500 tons a month for this year.
Okay, and for leads, the value added and the vanilla lead, what's the revenue mix percentage-wise?
It is around 60-40. 60% value added.
And the EBITDA per ton for that?
EBITDA, we can take only average EBITDA. We cannot give separately.
Okay. In the last quarter also, like the green lead, you were going to give the update, but no update has been coming from the company. So any updates on that, on the production from green lead process?
So green lead, what has happened is, we categorize the project into feasibility, pre-feasibility, and execution stages. Now, green lead being the process, which is hydrometallurgy, and to kind of scale it at similar cost levels has been a journey for us for the last 1.5 years, I would say. So we have right now put it in the feasibility stage, and we are analyzing the commercial viability on a large scale basis. Because again, the new technology, it is, like I said, the hydrometallurgy, expansion of it will eventually take some time. So we are right now at a feasibility stage to analyze the commercial viability at a large scale level.
So this, if it happens, this will apply to the existing production as well, right?
No, lead operations are not going to be affected by green lead operations at all. So we have, almost 3 decades of experience in lead. So lead is our hero product, which will remain for good. But then green lead, yes, for green lead. So lead operations is more of a pyrometallurgical operation, which we've been experienced and well versed with for so many years. But green lead belongs to the hydrometallurgical category, and scaling it up there in phases would take some time.
Okay. In the EPR update, so currently the government has like 30% producer recycling for this year targets, and we have not yet registered ourselves. So what would be the process right now for us in the EPR?
EPR already we registered for Andhra Pradesh unit, and the Tamil Nadu portal was not functioning for so many months. We are closely following it up with the government agency. Now only it started working. Already we applied for Tamil Nadu also.
What kind of MT like metric tons we have applied for?
Based on our consent for operation quantity, we can apply.
So Aniket, what happens is we are going to cater to the EPR as a recycler. We are not here being an OEM or a consumer or an aggregator. So the kind of quantities that will be applied here would obviously depend on the domestic procurement, what we get through an EPR. Fortunately, in our state, in Tamil Nadu, we've already started receiving soft and hard calls both in terms of reaching out to us for EPR opportunities, whether and all from major OEMs. So like Mr. Kumaravel just mentioned, unfortunately Tamil Nadu portal of EPR from the CPCB and MOEF was taking some time. We've already applied for Andhra, and we've already received the EPR there. So we'll be starting EPR credits from there, and we'll be able to give you some highlights probably in the next earnings call. Yeah.
Okay. Thank you for the answers, and that's it from my side.
Thank you.
Thank you, Mr. Aniket. Let's try Diya Brijwani once again. Operator, can you please allow Diya? Let's see if her technical issue has been sorted. Diya, please go ahead. Yeah, you're audible. Go ahead.
Yeah, I'm so sorry for the technical glitch. So my question was regarding the EPR, just to follow up. So if I just look at the regulations of 2022 and compare it to 2001, even in those 2001 regulations, it was stated that the producers need to collect back, let's say 50% of the batteries sold. But that failed. Of what I understand, there's a significant leakage from the dealer side, wherein the informal smelters, they offer a higher price to the dealers. So in that case, how do you see this fundamental problem going away with the new regulations coming in?
Hi, Diya. So in fact, we were, last month on the panel also for discussion on EPR specifically for the lead acid batteries. And And we are happy to inform that. So lead acid battery, as far as the journey from 2001. So it all started with the battery waste management handling rules, right? And then it kind of again evolved through a lot of discussions with the CPCB, the Central Pollution Control Boards, and a lot of other state pollution control boards and the MOEF. And then came the battery waste management rules. And through a lot of push from the industry, I'm talking about the organized industry, we finally got the extended producer responsibility rules and guidelines from the government. I mean, it was a great milestone for all the stakeholders in the government, because this industry has, on the domestic front, unfortunately been a very unorganized setup earlier. But then times have changed for us also. And fundamentally, like you rightly pointed out, it is going to be a challenge for a couple of years initially, because we see a very positive change in development happening. Now, when you say there's a leakage from the dealer, yes, there is, and there would continue to be. But then transitionally, it would kind of reduce, because each recycler and OEM would continue to penetrate the market further. So once the EPR registrations are kind of given, and the quantities are set forward, so every organized player, say for example us, will reach out to major OEMs or the industrial players, all the automobile industries, all the IT sectors to kind of gather batteries, and where we can award the EPR certificates, which adds value to both our ESG goals and also to the commercialization of EPR, if I may say so, because each EPR credit carries a certain value. In fact, last week we were discussing on the values of EPR that it will carry, and also the penalties that the stakeholders will have to pay in case they don't adhere to the guidelines. So fundamentally, we see it as a very positive change happening, and over the next couple of years, we will see the domestic numbers of procurement being well increased to 30-40% levels, and have a balanced approach with imports. I hope that answers your question, Dia.
Yeah, so thanks for that explanation. But just one question. We haven't, the board hasn't really finalized, the government hasn't finalized on the penalty amount or the credit value yet, right?
No, not yet.
Okay, so once finalized...
But they fixed responsibility responsibility on the battery manufacturers to collect the entire battery from the dealers. That responsibility they have fixed on the battery manufacturers now.
Got it. Okay. If that avenue really opens up, then we can add in revenue through EPR credit sale as well, right?
Yeah.
Yes. So we are looking that as a vertical for generating profits as well. So that is also something we are majorly looking at.
Got it. Cool. That's it from my side. Thank you.
Thank you, Dia. The next question we'll take from the line of Abhijit Mitra. Abhijit, please go ahead, unmute, and you can ask your question. Abhijit, please unmute yourself.
Yeah, thanks for taking my question. I hope I'm audible.
Yes, go ahead.
Yeah, a couple of questions. Firstly, on the capex targets for the next couple of years, so just to sort of have a clarity on the actual capex that you are planning to spend for 25-26.
Can you please repeat your question, Abhijit?
The capex targets for 25 and 26. How much capex are you planning to spend for fiscal year 25 and fiscal year 26?
So fiscal year 25, so we've already kind of invested last year for the acquisition of Harsha Exito, and this year we would we have a capex plan to invest about 100 crores in the entire scheme of things for the particular project in question, and likewise next year as well, seeing the business fundamentals and opportunities, we'll add on another 100 crores.
Got it. And what's the expected margin profile? I can understand there's several expansions projects which are going through, but how do you see your margin profile evolving over the next couple of years?
So it is very important to understand that we have had that learning curve in plastics and aluminium since the last 1 year. and the margins will again start spelling out, in this year, specifically for plastics. And coming to lead, so what we see with the upcoming plant, we see a lot of positivity in terms of the automation and the operational efficiency it will have. We look at it from a point of view that it will be a benchmark plant for us in India, and of the highest global standards, and it will generate a lot of operational efficiency. So that kind of takes care of the lead segment. In terms of profitability, right now we are at 6.5% levels for lead, 6 to 6.5%. We see ourselves increase through operational efficiency by another 20 or 30 basis points, or maybe a little more as time as we see the project shape up. Coming to plastics and aluminum, coming to plastics first, we will eventually, as we kind of find stability in the current phase and expand further, we will see margins improving in the current years. Now, the entire idea is whatever we've invested so far has to kind of give us the benefits, so that we have that business fundamental of reinvesting it again and getting benefits out of it. So we see a lot of positivity in the coming years for the investments that we have made so far, and the investments that we're going to do.
Got it. And since producers are already buying EPR credits in some of the sectors, so I mean, have you sort of built across any numbers on the expected EPR credits in plastic, or that you are about to get over the next couple of years?
So lead batteries, yes, we're looking at a number. We are in fact having, so as I mentioned, we are having soft calls and hard calls where we are reaching out to players and getting the interest built up as to what proposition we bring on the table. And I mean, we will soon, like I said before, we'll be setting out the investor presentation where we'll kind of highlight how EPR can shape up as a profit center in the coming months and in the coming quarters.
Got it. Understood. And the last question is on the supply chain. Just to understand, your lead and plastic supply chain a bit more for the domestic, supplies that you're getting or procurement that you're doing. How unorganized is the space? And is that sort of a headwind to ramp up volumes in the segments?
So we work, fortunately for us, we work 100% on the organized segment. Compliance is, of course, foremost importance for us. But the advantage is that the unorganized sector is moving towards being organized. So that is kind of a ray of hope, and also an advantage which we will tap on to as an industry, the organized industry, in the coming months and the coming years as well. So if today I see the unorganized market roughly to be 60 to 70%, so that number will probably decrease in the coming years to say, for example, 40% would be unorganized, 60 would be organized. So, and that would kind of give us big benefits. That is as far as lead is concerned. Plastics also, I mean, EPR, we see a lot of interest coming in. But right now, what we are looking at is polypropylene copolymer. That is one grade. In the coming months, and as we move forward in the plastic segment, we will be looking at alternative grades as well. Whether it's ABS, whether it's nylon and other engineering plastics. So we will eventually find a common balance between both the verticals.
Okay, so the level of organization in the plastic sector is not a constraint for you as of now.
Sorry, can you please repeat?
I'm saying the level of unorganized supply chain in the plastic sector is not a constraint for you to sort of shape up.
Of course, it
volume.
is constraint. It is because the market is sort of fragmented and concentrated earlier to the unorganized players. Now, when the transition happens from the unorganized to the organized, that transition will take some time, but then transition will be long term and will help the entire industry as a whole.
Got it. Thanks, and wish you all the best.
Thank you.
Thank you so much, Abhijit.
Thank you, Mr. Abhijit. Ladies and gentlemen, I'm going to give a few seconds to see if there are any more questions on the line. Again, if you have any questions, please do use the raise hand functionality. Okay, we have additional questions from Giriraj Daga. Giriraj, please limit yourself to just 2 questions. Go ahead.
Yeah, hi. Just one on the follow-up on the EPR questions. So just to understand, we'll get only credit for the source what we buy domestically, right? The raw material, or is it like all?
No,
It's only for domestic.
So it's only restricted to domestic, Giriraj. Only
Sourcing.
domestic, not for imports.
Okay. And this is not fungible, just a broad thought. I don't know, I'm not too
I'm
deep
sorry?
into this APR is not a fungible thing like the other sector. Like obviously in this quarter we saw a couple of tire companies paying very high cost on the APR.
Yeah, yes. Okay. So what happens really is, say for example, if I have a customer or an OEM A who wants to recycle his batteries through us, so we'll have a set EPR commercial cost. If we allocate, say, I mean, just on a very high level example, I'm saying if it is a 5 rupee or a 10 rupee per kilo, which would be the market cost. So we'll attribute that to the cost of procurement, and the net amount would be our effective cost of procurement for batteries. And the same approach will apply to plastics, to the lithium-ion batteries, to the tires, and to the e-waste as well, where EPR is applicable.
No, my question was that let's say like the tire companies are made to pay. The battery companies like Exide or Amara are still not being paid, first of all. The other part was that, let's say, can tire company buy EPR from, like, it's not, the segment is clear, right? Lead EPR will have lead EPR.
No, it's not cross-functional. It's not cross-functional. There are separate rules for tires, e-waste, lithium-ion batteries, lead-acid batteries, plastics.
Okay.
Plastics itself is it's categorized into 4 categories: rigid, flexible, and the others also, multi-layered and others. Yeah.
Okay. And why? Any thought? Obviously, the companies would be more appropriate, Exide and Amara, but any thoughts why they are still not being asked to pay penalty, unlike tire companies? Are they still matching all the EPR guidance, or there is some still leeway out there?
No, so I think Diya Brijwani had raised this point. So nothing has been formal. So the penalties and the cost of compensation has not been yet finalized. So the point of discussion is we have to start at a given point of time. Unfortunately, the government has started this particular activity of EPR. When it comes to penalty and compensation, those numbers are not yet finalized. So there will be a cooling period of the date of, coincidence when this compensation will get attracted to the OEMs that you've mentioned. But there is no such reason as such, because some rules are still yet to be finalized on a broader scale.
Okay. Thank you. That's all from my side.
Thank you, Giriraj.
Thank you, Mr. Giriraj. Looks like we have a follow-up question from Aniket Gada. Aniket, go ahead and ask your question. Please limit it to 2. Request.
I just wanted to follow up on the EPR itself. The example that you given, the EPR cost that the producer has to is burdened with, do we get additional margins on that? Will the margin expansion happen for us in case of EPR happens?
So there are various stakeholders in EPR. So we can discuss at length, but I'll just give you a very high level understanding. So there's a producer, there's an aggregator, there's a dealer, there's a consumer, and then there is the recycler. Now responsibilities have been allocated to all. Now when it comes to the commercialization of EPR, yes, you're right, it is possible, because EPR is an activity that a recycler will carry out, because they will allocate a cost of storage, they will allocate a cost of conversion, they will allocate other costs as well. So yes, it can be commercialized. To what extent, only time will tell. No. Right now, the rates are different for different forms of EPR credit.
No, because of EPR credit, margin will go up. That is your question, no?
Yes.
Yeah, margin has to go up. Our procurement cost will come down.
Okay. My second question is on the plastics division. What kind of margins do we currently have, and what are we expecting for the FY25?
So right now, what is, again, to reiterate, right now, the margins are, just 1 second, please. So right now, the material margins is about 11.7 to 12% on the material margin level. But given that we are stabilizing and there is a cost of entering a market, because this is not something which we were there earlier, we have entered the market. And fortunately, if you look at both the divisions, plastics and aluminium, we've built a very strong case of 21 crores and 42 crores. So we'll be looking at margin of roughly about 6 to 7% this year.
6 to 7% the net basis, right?
EBITDA. Yes. But again, this is the vanilla items what we'll manufacture. When we start adding filled and added compounds, those will give us better margins. But that entirely depends on the business fundamentals that will exist in the coming period.
Okay. Thank you.
Thank you, Aniket.
Thank you, Mr. Aniket. Ladies and gentlemen, I guess that's all the time we have allocated for today. Please do send in your additional follow-up questions by email to us, and we will get those answered by the POCL management. Thank you all for joining us for the Pondy Oxides and Chemicals Limited Q4 FY23-24 earnings call. And as a reminder, today's call was recorded. A replay of this call will be available on AlphaStreet India's YouTube channel as well as AlphaStreet.com platform. A final transcript will be available shortly on AlphaStreet.com. Thank you everyone for joining the call, and thank you Pondy Oxides and Chemicals management team.
Thank you.
Thank you, everyone.
Thank you.